to this webinar that will be looking at a regional perspective of the pre-budget and, of course, financial sector. And, of course, it responds to COVID-19. Today, we know all of us tomorrow, the budget is there. But before we do and start this officially, I would want to request that those who are present in this meeting, that we observe a minute of silence. And the idea of a minute of silence, you know, we have lost one member of the Heads of State Summit, the President of the Republic of Burundi. So this being a regional activity, it befits that we give that respect and all of us converge and give a minute of silence in honor of His Excellency President Pierre Nkurunziza, who passed away. So I think it's only fair, all of you who are in this, we give a minute of silence. So if you hear me keep quiet, you know the minute of silence has just begun. May his soul rest in eternal peace. So that was a minute of silence in respect to the passing away of His Excellency President Pierre Nkurunziza of the Republic of Burundi. And this being a regional activity, obviously, it is important that we undertake that very important responsibility, knowing that Burundi is one of the key member states or partner states of the East African Community, and also within the framework of the East African Business Council. Now, ladies and gentlemen, we know tomorrow, 11th June 2020, the EAC partner states will be reading their budget 2020-2021. And therefore, we are meeting here today to think through, come up with some ideas, of course, even some opinions and how we share, how we foresee the whole process to be, and give suggestions. Of course, we know it's always a process. As the East African Business Council, we were afforded an opportunity to share, of course, our thoughts through different organs of the East African community, which we did. And therefore, we felt it's important that today we discuss these things and how they're likely to impact the economies in East Africa. Of course, it's unique. It's a unique budget time process. One, because of the situation the world is in and also the community. COVID-19 has not spared the business sector and the economies of the community. And therefore, it is important that we scan and share our thoughts on how we would expect this to be. Of course, we are joined by an eminent group of panelists who are joining, and I want to thank them very much for creating time to be with us. And therefore, we are joined by Mr. Abib Olaka, is the Chief Executive Officer of Kenya Bankers Association. Of course, we have Mr. Haji Ibrahim Kadunabi Lubega, who is the Executive Director of Insurance Regulatory Authority of Uganda. Of course, we have engineer Jennifer, who is with us, and in a very special way, Engineer Jennifer is a good, is a special friend. I would say a special friend of the community, and particularly the business community. And therefore, it's important that that she's here. And I want to thank you for creating time to join us this afternoon. And then obviously we have our good friend who is joined us from the Ernst & Young, Tanzania, Mr. Joseph Shefu, Country Managing Partner, Ernst & Young. I want to thank you for creating time. We are going to really listen from you. And of course, what you would expect from the community and particularly partner states. Of course, different partner states have responded, have put in different, options, approaches when you come to economic stimulus. But of course, expectation is there, particularly for business sector going forward. Because again, we are to go be a post-COVID, then we must be able to understand what is it that business is expecting. What are the SMEs expecting? What are the manufacturing expecting? What is the tourism expecting? What are the things that this budget that is being read tomorrow must really factor in going forward? I think it's important that we discuss these things. This is a program that is watched all over the world, all over the region. Quite a big number is watching through our social media, through our Facebook, through our our different social media channels. And therefore, obviously, whatever is coming out of this will form basis of what, obviously, again, would expect in terms of influencing businesses. So I want to welcome all of you. I would want my colleague, Miriam Mondosha, who I'd want to introduce. Miriam Mondosha is one of the top-notch experts within our secretariat, and she'll be taking us through today's session. She will take us through the program. She'll take us through all the items that are in the program, and therefore I want, in a very special way, to invite Miriam Mondosha to take us through today's program. Over to you, Madam Miriam Mondosha.
Thank you very much, Dr. Mathuki. Good afternoon, everyone. As introduced, my name is Miriam Mondosha, and of course, I'll be taking you through today's webinar that will give regional perspective on pre-budget, and of course, I will focus on the financial sector and how it has responded to, of course, the impact of COVID-19. Before we start, I would like to take you through the ground rules that will follow in today's webinar. Of course, is to remind you to mute your mic and the video if you're not on the stage, and of course to respect all the views of all the panelists, to contribute to the meeting goals, and of course staying on point and keeping time. And of course, as it was initially stated, I will be giving out regional perspectives in this webinar. Yes, and of course, all the questions should be directed to the chat room. We have a dedicated team from the Secretariat that will be picking up your questions for the panelists. So please make use of the chat room. And of course, the meeting will be recorded for reporting purposes, and the report will be shared right after this meeting. So before we start, I would just like to confirm the presence of all our mentioned panelists. If you can, of course, let us know if you're present, starting with Mr. Joseph Shefu. Are you present?
I'm present. Thank you.
Thank you, sir. Dr. Olaka, are you present?
Yes, I'm present. Thank you.
Thank you. Engineer Jennifer.
Yes, hello, Miriam, I'm present.
Thank you very much. Alhaji Ibrahim Kadunabi Lubega.
Thank you. Alhaji is represented by Protasio Sande. He's just been called for some meeting at the ministry. Protasio Sande is Director of Planning Research at the Insurance Regulatory Authority of Uganda.
Thank you very much. And of course, we have another panelist, which is Mr. Sanjay Rugani, who is the CEO of Standard Chartered Bank in Tanzania. Please confirm your presence. Mr. Sanjay Rugani. Okay, I think we can proceed with the panelists that are available. Of course, as the background that was given by Honorable Dr. Peter Mathuki, we all know that our region has been impacted by the COVID-19 pandemic. And of course, many sectors have been affected. And of course, there's a multiplier effect due to intersectoral linkages in our region. And of course, the financial sector, which is one of the key sectors, has also been hit. And of course, the focus of this webinar will be to explore how it has been impacted and of course, how it has responded to mitigate the impact of the pandemic. And of course, being that tomorrow we'll be listening to the budgets from the partner states, various partner states in East Africa, would also be exploring what the perspectives are and what we should be expecting from, of course, the budgets tomorrow, in order, of course, to address the impact of COVID-19 in our region and in our economies. So starting with Mr. Joseph Shefu, of course, being that we know that our economies have been largely affected by COVID-19. And of course, we've seen a lot of negative effects, and of course, we've seen a lot of opportunities also from the pandemic. So from the insights of EY, what is the economic outlook of the 6 partner states in East Africa, of course, with regards to the effects of the pandemic? Welcome. Please unmute your mic.
Yeah, thank you so much. So in terms of the economic outlook, I would say there are 2 sides to look at it in terms of the way the economy in East Africa states in each country are built on. With the aspect of formal sector and informal sector, we could look at the role played by the informal sector as well. So I think the most recent publication, and I'm going to refer to the World Bank publication on the Africa Pulse, that which also issued in April this year, covered the COVID aspects. So, and East Africa is not in isolation. We look at the Sub-Saharan Africa in general, whereby it's predicted that the COVID is likely to drive the Sub-Saharan Africa into its first recession in 25 years, with the growth potentially falling as low as negative 5.1 in 2020. So, and certainly that is likely to push millions of households into poverty. We certainly expected, and that's already been felt, food security is at risk because of trade disruptions, low agricultural productions, fewer foods imports. And but also when we look at it in terms of the structure of our economy, 90% of our people are working in informal jobs, and it's harder to reach workers with the support that they need. If we could look at projections for each of the individual East African countries, we see that, for example, Tanzania, and that's according to IMF projections, we are likely to close 2020 at GDP growth of 2.01%. And if we compare to the past, we're looking at, we recorded at least 6.27% in 2019. Kenya is also largely impacted with outlook of 1.01%, and certainly as a baseline, and potential is going to be probably 1.1 flat 1% growth. And but you could look very recently, Kenya had grown at 6.3% in 2018. Rwanda probably very much impacted. They had 8.6% GDP growth in 2018. And the outlook now is about 3.5%, and similar to Uganda, from 6.2% in 2018, and with outlook of 3.5%. Burundi probably is expected to be hit hard in the community with a projection of negative 5.5%, and that's really down from positive 1.6% in 2018, and Southern Sudan will probably be the only country that is probably expected to grow at 4.5%, up from 3.2%. So, but we could see probably East Africa is probably faring much better compared to peers in Sub-Saharan Africa, where we have GDP decline up to probably beyond 5% negative. But again, that's really skeptical in the sense that the impact of COVID, which probably we started feeling it since mid-March, and at present we start feeling the impacts, and we could probably call it early impacts, but probably we will feel more impacts in the medium terms and long terms. And God forbid, certainly all these predictions around the potential for the second wave of COVID, second and third wave, based on the Spanish flu experience in the past. But certainly we pray to God at the end that we don't really face that. It's going to be a period of time before we see the vaccine coming out, and certainly we still have to remain vigilant. Yep, that's probably my outlook, the way we look at it at present.
Thank you very much, Mr. Shefu. Of course, you've highlighted how the economic growth in various partner states has been impacted, and of course, how we should expect more effects in the medium and in the long term. And in your opinion, given that the outlook that you've presented, what do you think would be the major, of course, fiscal and monetary measures that the private sector and, of course, East Africans can expect from tomorrow's budgets? And, of course, this is with the focus of cushioning the impact of the pandemic to businesses, and of course, with the view of stimulating growth and recovery in our region. Welcome.
Okay, thank you. So what we have seen that the government of East Africa owed its citizens the duty of care, and hence the various measures that have been taken thus far in responding to the pandemic. And these include social distancing, total partial travel ban, and total lockdowns. The measures by the government in East Africa, I'll probably say that they were pretty similar and somewhat different across the community member states. So East Africa businesses and economies were impacted in a similar way, but also differently. And this is totally expected due to the socioeconomic disparities among the states, uniqueness of each member states, cultural difference, and perhaps political ideologies But what's important is that all government in East Africa took measures within the framework and the mandates given by their people. So, and certainly, and I said like similar but disparate, and really address the uniqueness in each of those countries. And I would certainly refer, first of all, on the survey that was done by East Africa Business Councils in terms of the impact. And this is really early on impact. We would see that the tourism sector was largely impacted, especially on the aspect of cash flow with the closure, travel bans, whether these were total travel bans or domestic travel bans, but the hotels were shut down. And we could look at the contribution of the tourism sector and the economy and what measures that the government can target on specific sector. And certainly in each sector, the government interventions, both fiscal and monetary aspects can differ, depending exactly in terms of the contribution of that sector and how that sector plays into the economy. So 92% based on the survey by South Africa Business Council were impacted, especially in reduction of cash flows. The second sector was logistics at 75% of the respondents actually that indicated. Retail sector was the third at 63%. Followed by real estate and financial sector as well at 50% impacted with a reduction in cash flows. And ICT, probably pharmaceutical, is one that didn't indicate to have been much impacted from the cash flow point of view. But again, cash flow leads to directly to disrupting value chains, business potentially result in business closing down and also impact on labor market in terms of retrenchment. But again, for the pharmaceutical, kudos goes to the East Africa states, which allowed movement of essential goods, such as pharmaceutical during the pandemics. But if we could focus on the individual, some of the measures, I think one of my colleagues will touch on it. So on the cash flow constraint in the business community, we could look at different countries. One of the key issues, for example, in Tanzania is refund from the treasury, and this is with regards to VAT refunds. The lead time that it takes for businesses to get these refunds, legitimate refunds from the revenue authorities, if that can be hastened. And also we have significant arrears to suppliers in the government. The government is a major players in the economy, and is also in terms of the major consumer of goods and services from the private sector. If those cash flows tied up, they can be released. Some private sector are not looking for probably grants or anything, but they just want to have their cash flow improved by services that were rendered. But also in terms of access to finance, the financial sector are looking at businesses as being more riskier now, given the disruption in supply chains and the risk of default of payments because of the trickling effects of the disruption on the supply chains. So how do we address the impaired credits of businesses in Tanzania? So, and that's where we're looking at the Reserve Bank in terms of what sort of policies from the monetary point of view that can actually help. And we've seen actually governments across East Africa coming up with those measures in one way or another, really to try to stimulate financial sector to provide more credit and liquidity to the business sectors to fill up the gaps of the impacts that businesses are from. So lowering interest rates by the Reserve Bank to enable commercial bank to borrow at a lower rates is commendable. Central Bank in East Africa have collectively taken those measures. Probably there's one or two countries that hasn't really adapted, but it's never too late. Then central bank need to extend lending facilities to commercial banks. Commercial banks are also facing pressure now. They have to restructure some of their facilities and loan books, for example, and therefore they have cash flow mismatch risk that is coming up. So any intervention from the central bank from a monetary point of view would help. Reduction on corporate rates is also one of the potential policy that can be taken from the fiscal point of view. but also relief. So businesses, some of the businesses have actually tried to maintain their workforce, but what sort of incentive that are there or assistance to enable them to maintain that position that they're holding? So any rebates on pay-as-you-earn or relief on workman compensation, for example, such measures will go a long way to sustain the private sector in terms of supporting to drive the economy. So in the tourism sector, we have seen in the past as governments had introduced VAT, for example, in Tanzania, for tourism services, and if those some of the aspects that can be reconsidered, and also in terms of lending cost for aircrafts at the airports, and stimulating also export to businesses in terms of regulatory costs, and those are some of the areas that need to be looked at. But most important is really for the government to look at is the creation of employment, because the private sector is able to absorb a much larger portion of employment. They can preserve employment. So, and it's a balancing act between stimulating economy and immediate needs for government revenue. Also, they have to run infrastructure, and we've seen the health sector has been severely impacted, and hence the government is also trying to raise those revenue. So this balancing act can work very well in terms of engaging both the private sector and the government sector. And the donor community, we have seen other countries benefited to attracting support from the donor community, with Kenya, Uganda benefiting from the IMF and the World Bank facilities, and Tanzania as well benefiting from development partners in one way or another. So those are some of the measures that can be considered. Thank you.
Thank you very much. Thank you very much, Mr. Shefu. Of course, you've highlighted the focus being on addressing the cash flow constraints, and of course, promoting access to finance, creation of employment, and also focusing on potential.
Sorry, Miriam, you are on mute.
Sorry. Thank you very much, Mr. Shefu. Of course, you've highlighted measures that will be aimed at addressing the cash flow constraints, and of course, promoting access to finance, addressing, of course, the issue of employment and a potential reduction of employment taxes. Thank you very much for that. I'll come back to you later. So moving on to Engineer Jennifer Gache, who is the Industrial Development Advisor at the EAC Secretariat. Given that what we've heard from Mr. Shefu, Engineer Gache, what do you think we should expect from the budgets of partner states, of course, with regards to promoting the sustainability of businesses and ensuring that the regional value chains are uninterrupted in our region? Welcome, Engineer Gache. I see Engineer Gache is on hold. If we can proceed with Dr. Habil Olaka, the CEO of Kenya Bankers Association. Dr. Olaka, as we know that the banking subsector has also been hugely affected by the pandemic. If you can enlighten us on what the challenges have been faced by banks during this time, of course, focusing on how the credit to private sector has been affected, and of course, giving us a view on how the subsector has responded to the challenges brought by the pandemic. Welcome, Dr. Olaka.
Yeah, thank you very much, Miriam. Indeed, I would start by saying that the pandemic has had adverse ramifications across all key sectors of the regional economies. Of course, banking included, but not the main one. I think it has been across all sectors, given its unprecedented nature. Foremost is a health pandemic, an aspect that has got a direct effect on people's well-being. So it affects not just the banking staff, but the customers of the banks and the suppliers of services to the banks. It pervades all across. It also has had simultaneous demand and supply effects. And in this particular case, unlike shocks that are one-sided, this particularly poses a challenge in terms of the measures that can be taken with a policy or market that you need to put in place to navigate the shocks. It has also had the effect of undermining confidence, given that it has created heightened uncertainty. The forward planning horizon, of course, has been drastically reduced. So most businesses are currently operating less in an investment mode and more on a day-to-day survival as they struggle to utilize existing capacity. And of course, the banking sector has been at the center of the situation, at least in my view, two respects. One is ensuring that they are able to help stabilize the economic system through ensuring that there's availability of funding in support of the households and businesses that have been severely affected by this pandemic. And also ensuring that as they support businesses, the stability of the banking system is not jeopardized. And I think this is a very key factor, because you would not want to move out of a health crisis and move into a financial or banking crisis for that matter. Because if the economic challenges filter into banking system challenges, that will definitely prolong the effects of the pandemic on the whole economic system. So against this backdrop, I think I see banks have been coming in a number of ways. For example, I think it was Mr. Joseph Shefu who said that banks have been supporting borrowers by way of restructuring the existing loans. So we've seen a lot of demand of customers who have been affected in various ways, approaching their respective banks for form of accommodation. So restructuring the existing loans, extending moratorium, amending the repayment structure to accommodate them. There's also been the lowering, and in some cases actually suspending the fees and charges that that would normally be applied to specific transactions. This is basically just to boost the customers' disposable incomes. And on the existing loan books, I think we have seen banks taking a very keen look to ensure that you avoid the slippage into the non-performing loan portfolio rather spinning out of control. Because this is a very likely possibility, so banks will need to be extremely careful. And then, of course, also putting measures into place to ensure that that staff and customers remain safe from a health standpoint, and ensuring that they continue offering essential services even as economies or part of them are in lockdown. Banks have also been evaluating carefully the new loans that they write, and this has slowed the supply of credit to the private sector. We have also seen, obviously, the weak non-financial private sector operations, where demand for credit is equally weak. And the combined supply and demand effects have resulted in slow growth in credit to the private sector, this happens at a time when growth in the private sector credit and giving Kenya as an example has been extremely slow. But banks have been able to come up with these forms of support, essentially cushioned by the support from the respective central banks to avail liquidity to be able to support the economic activities in the respective countries. And I can just mention, for example, just seen some review of the extension of an economic recovery fund in Rwanda, supported by, provided by the Central Bank of Rwanda, where banks can be able to access through this facility liquidity. And for the case of Kenya, what the central bank did is that it lowered the cash reserve ratio, which means that a proportion of the deposits that banks are supposed to retain at the central bank was lowered, and therefore availing liquidity to the commercial banks, and they have been able to effectively use this availed liquidity to support economic activity through availing facilities, either through restructuring or fresh liquidity to the borrowers. Thank you.
Thank you very much, Dr. Olaka. And of course, you've highlighted how the banks have responded to this. And of course, we have seen various central banks in our partner states also putting up measures that would, of course, increase liquidity and of course, promote stability of the banking sector. So from the Bankers Association, what do you think would be, of course, the immediate and the long-term measures that can ensure stability of the banking sector in our region? And of course, what are the lessons that we can draw up from this pandemic with regards to the financial sector? Welcome.
Yeah, I think one of the things that we can observe is that this crisis happened at a time when the banking sector across the region actually are fairly well capitalized. Number of central banks have put in place, requirements for buffer capital over and above the minimum regulatory requirements to enable the banking system withstand shocks, so that you build up your buffers at times when the system is fairly stable. And these normally come in handy, and you have seen in the region these have come in quite handy at the time when they are required, like now, when you have got some shocks in the market. So this is, I think, a plus for the regulatory regime in the region that has been fairly proactive and supportive of stability, with a forward-looking approach to build buffers for times when the going can get tough as it's getting. And no wonder most of the banking system in the region, in the five countries, relatively fairly well placed from a capital standpoint to be able to support the economic recovery. And also the other point that possibly I can also mention at this point in time is at the core of this sustained stability is actually innovation. And innovation, we can look at it at two levels. We can look at it from the use of technology to enhance the efficiency in operations in the financial services system, if we can be specific to the banking sector. And also, secondly, there is also the innovation from the point of view of product innovation, both for growth and ensuring that there is access to the financial services. And I think this the banks that have weathered the storm, or those that are appearing to be able to withstand the storm, are actually those that have been on the forefront of innovation. If you look at it from the point of view of accessing services, those that were a step ahead and are able to leverage onto the digital platforms to be able to continue offering services even as the containment measures are put in place, and therefore the accessibility of customers to the financial service providers become challenged. They are still able to continuously access their customers through the digital platforms. And I think those that had invested on the digital platforms are the ones that are weathering this storm. And also even in terms of, for instance, the security posture by the banks, especially as they move on the digital platforms. Most of these platforms become also easy targets for cybersecurity threats. And those that are innovative in terms of coming up with an appropriate security framework are those that will be able to withstand the challenges that come from this. Of course, one of the things when you talk about the lessons that have been learned from by the financial sector from this pandemic, one is that not every shock can be envisaged and therefore planned for. We have had a number of shocks that have hit us. A number of them may have been possible to plan for in the horizon. But honestly speaking, this one, we would not have possibly have had it in our strategic or in our contingency planning. And even then, if it was not with the same kind of heightened level that we came to experience. So out of this, I think one lesson is that it therefore makes sense to be agile and adaptive to new situations, basically taking in the new situation as your new normal and being able to quickly adjust your systems and be able to quickly operate and move into the new normal as quickly as possible. Those who are left in the old trying to take time and slowly with inertia move into the new normal find it difficult to move on. And two, I think it also serves the banking system to balance between growth and stability. I think the sufficient capital buffers that I had alluded to a little bit earlier could mean being less profitable, but being more stable. So you actually achieve stability by foregoing some opportunities for profits, which is a strategic business choice that an institution needs to make, and it is something for the better. So I think that's a major lesson that financial institutions will learn from this shock. And therefore, there should not be perceptions of trade-offs between large buffers and profitability. I think the issue is that you need adequate buffers as you pursue, of course, your profitability objective as well. So just as a final thought, I think innovative business practices are an imperative for financial institutions. As consumer behaviors and preferences change in response to this COVID pandemic, I think those that will be innovative in terms of their business practices will be the ones that will be able to survive this challenge. Thank you.
Thank you very much, Dr. Olaka. And I would like to stress, of course, your last point, that innovative business practices are something that all banks can learn and cope during this time. Thank you very much. I'll get back to you later. I would like to confirm if Mr. Sanjay is online. Mr. Sanjay Rugani. Mr. Sanjay Rugani. All right. I think we can proceed. Is Engineer Jennifer Gache online?
Yes, sorry, I'm online.
Thank you very much, Engineer Gache.
Yes.
Of course, we had listened to to how various partner states have been affected during this time from Mr. Joseph Shefu. And of course, he had highlighted on what measures we should expect from tomorrow's budget. And of course, being an expert in industry in our region, what do you think we should expect from the budgets tomorrow from the partner states? Of course, with the view of making sure businesses are sustainable and our regional value chains are uninterrupted. Welcome.
So thank you very much, Miriam. The region aims for sustainability, as you've heard from the other presenters, and also has targets for development, whether it's the GDP growth or some sector targets. So as with most sectors, even in the banking sectors, even manufacturers would wish for improvement of competitiveness of their business and to bring the costs of operations down. So when you look at some of the issues that our manufacturers have been grappling with, has been the issues of unfair competition when it comes to imports, some illicit economies when you have some products which are illicit getting into the region, and in some cases, the unpredictability of policy and the regulatory and even the business environment. So when you look at all these factors from the regional level, the region would want to have some of the measures that aim at, can I say, protecting their sectors. So at the EAC level, we have the common external tariff that is there to see to it that the business in the region are sustainable, and so some sectors are taxed, especially in areas where the region has sufficient capacities for production, and then at least the government uses that way to get some taxes, but at the same time also protect the industries, some which are nascent. So at the regional level now, we have been working on the comprehensive common external tariff, and this has not yet been finalized. But so far there are 3 tariff bands of 0%, 10%, 25%. So even as the region works towards completing that study and making a tariff that is going to protect the value chains and to promote more of manufacturing, there is an expectation that still the East Africans would like to see the governments maintaining the protection of some of the sectors. There are some sectors which the region is moving and almost each and every country in East Africa is moving towards its development. These are sectors like the textile sector, where we have a number of players, steel, and some other extractive sectors, leather, pharmaceutical, and agro-foods. So there are some certain aspects of these sectors that have got sufficient local capacity and need to be protected. Another something else which the region is looking at, and I think has also been affected by this COVID, is the access to raw materials and inputs. How do our region get from imports raw materials and inputs? Some are available in the region, but others are not. So where the region does not have capacity, then the manufacturers would like to get these inputs at a lower cost. So there's a proposal for an EAC-wide duty remission proposal. I cannot go into the details here because some of it is quite detailed for this audience, but essentially there's a need for import duties at 0%, and these are for products which, of course, even if the region wanted, they do not have it, so they have to import it anyway. And so going on a case-by-case, considerations are being made to the government on how to have some of these to have this kind of duty remission. Of course, each and every country has their own proposals according to their own needs. But in this particular discussions, we are looking at the proposals for the region. Then all the time, the region aims at reduction in the costs of doing business. And of course, this is the financial sector. So I think my colleagues have covered this quite well in terms of how does the government work with the manufacturers around the VATs? How soon are these VATs being refunded so that they can provide a working capital to the people who need them? Is it necessary to use the approach that is currently being used? So these are some of the discussions that are going around. But and there is also the issue of the cost of infrastructure. For instance, when we talk about energy, this still remains also a factor which, if the region can be able to get less, tariffs for electricity, then of course their cost of production can go lower. So I think those are some of the issues that I can raise at the moment. Okay.
Thank you very much, Engineer Gache. Of course, you've highlighted a few things, and one of which should be measures that would promote access to inputs during this time, and of course address the cash flow constraints that the manufacturers are facing during this time. So moving on to Mr. Joseph Shefu. Given that, of course, we expect that the budget deficit might increase from tomorrow's budgets, how do you think you can advise the government, of course, to address the issue of the increase in the budget deficit, but at the same time also offer a stimulus package that will be aimed at mitigating the impact of the pandemic to businesses? So how can we strike a balance between addressing the budget deficit while also providing the stimulus package? Welcome, Mr. Shefu.
Yeah, thank you. Thank you so much, Miriam. So what I want to say is that the governments are being tested very hard by this pandemic. Certainly governments we still had issues, typically as developing countries trying to build our economies in the past, even just before this COVID pandemic came about. So with the COVID, the governments were forced certainly the government spending pattern were disrupted. So there has to be increased spending in health sector. And also we can actually see closure of schools impacting on the quality and quantity of educations. Vulnerable ones certainly are now looked at the back window, women's and children's. Supply chain disruptions. So, and when we look at that, the government still needed to fund infrastructure development, but now the question is still, where is the money? FDI has dried up, foreign direct investments. as potential investors also have to deal with the issues at their home countries. Businesses are making losses, so certainly government is not yielding any substantial, any meaningful income tax. Retail sector is disrupted, which means the indirect tax paid to retail sectors, like VAT revenue, is declining. So where is the money? So we are facing all these hurdles, and when this pandemic happens, which is very interesting, we all of a suddenly look at the governments as a savior and as an organ that can create orders. But certainly the government needs money to spend. So businesses have adapted and continue to adapt. We look at it as disruption from the business sector. So from the government sector, certainly the proposal is to also change their attitudes. So the government need to adapt a kind of Marshall plans. And have to depart from business as usual attitudes. So and I would say and it's very important that at this juncture also the government is looking at the importance of the private sector is called upon, because there's all this dependency between the government and the private sector, and at some point maybe one side is forgotten more. So private sector can be a savior, and what we see is that the government have to promote private sector by hooks and crooks at this juncture. They have to stimulate businesses by lowering taxes and administrative burden. I think the whole essence is that we have to widen the tax base and the tax nets to be able to include everyone who's supposed to be on that net. Business formalizations, over 60% we've seen of businesses in sub-Saharan Africa, and at the largest extent in some countries, I mean like Uganda, 80% informal businesses. And the government could focus on the inclusion of the informal businesses in the wider tax nets. So it really is to create a larger quantitative and qualitative tax base, which should improve on the government revenue. So on the other side, on the spending side, as I said, the government is to depart from business as usual attitudes and adopt a Marshall Plan. So we hope the government will prioritize sectors for spending vis-a-vis business as usual. Again, yes, we have education sector, we have health sector that we need to support the other sectors of the economy. The other governments have got more focus on infrastructure at this stage, building railways and roads. If that can also be based on feasibility studies that can be looked at in the lights of the current situations and the predicaments that we face at present, some of these feasibilities were based on assumptions which have been taken over by time. So there could be a gap in some of those infrastructures while the government is diverting funds to priority sectors that will absorb larger workforce. But it's most important for the East African economies to bring workers back to the income generation, whether it's in the formal sector or in agricultural sector. So that's important that in terms of so in terms of public debts, we have seen public debts has increased, and that is pretty expectedly. I think on the aspect of public debts, I think the emphasis has always been that these can be raised in a sustainable level. So government have to measure and assess their macroeconomic and in terms of their future economic growth plans and flows that is going to come in the future, and be able to build those debt levels. So as far as I understand, most of the East Africa community countries haven't really broken their public debt ceilings, which are in terms of thresholds that have been put by the World Bank. But of course, some of the countries are almost reaching those ceilings that has been actually achieved. But prioritizing again, those huge infrastructure. So I would say, if we put an example in Tanzania, I've seen major projects, Stigeless George, which is power energy, which is very important because entire Africa needs power, not only Tanzania, and our industries to grow, we need power, and also in the railway sector, but also questions were raised whether some of the roads that are constructed in areas, whether those are productive areas, and whether we should divert funds from construction of maybe roads in some streets in urban centers, which are not productive areas, to areas that are more productive, that will help in the supply chains, in agricultural value chains, or in export, for example. So those are some of the areas. Food security is an area that we could also look at it. There are some of the quick wins, which is in terms of our regional. If we can promote unity in the regions, promote intra-country trades, even within our own community. So let's open up those, break those hard trade barriers to allow free movement of goods from member states. We need to spur agricultural outputs as well to address the food security by looking at, again, reduction in tax and levy on implements, seeds, and in terms of all the supply chain to promote agricultural outputs. In the area around food storage, if we're going to increase agricultural output, we need to also look at the food storage and also incentive to businesses. Businesses that are still sustaining their businesses, they face hurdles in terms of doing business, permits, regulatory costs. If all this could be eased such that productivity can actually grow and businesses can actually grow, more entrants into the business will come in and hence more tax revenue. So this balancing act that the government has to look at it carefully, and they have to depart from business as usual, going back to the same taxpayer to ask for more and more money. And I think they're saying that we should not slaughter a cow. We probably want to milk a cow, but not to the extent that the cow will die. And probably we need to create more cows. And that's really the essence of how the government can work better at this juncture.
Thank you very much, Mr. Shefu. Of course, you've highlighted in the area of revenue. Of course, we need to focus on widening the tax base, given that our region is mostly concentrated with the informal businesses. And of course, on the side of spending, you've highlighted prioritization, of course, by the government. And also, you've highlighted on solving the regulatory issues that businesses face. Thank you very much. I'll come back to you later. I would like to remind our audience to please submit your questions to the chat room. If you have any question for our panelists, please submit them in the chat room. We have a team that will be collecting them, and they'll be asked here for the panelists. I would also like to confirm, is Mr. Sanjay online?
Yes, I am. I'm online. Thank you.
Thank you very much, Mr. Sanjay, who is the CEO of Standard Chartered, and of course, also the chairman of the CEOs Roundtable in Tanzania. So, Mr. Sanjay, we've had insights from Dr. Habil Olaka, who is also the CEO of the Kenyan Bankers Association. And of course, one of the striking points is that the banks that are faring well right now are those that had invested in, of course, the digital platforms. So my question is, how can of course, banks leverage on the digital platforms during this time? And from the regulatory point of view, what needs to be put in place to actually facilitate this, so that we make sure that the banking sector is not affected during this time? Welcome.
So I think you asked two questions. One is about digital, and two is really about, from a regulatory standpoint, what should happen so that banks are not significantly impacted. I'm going to start with the second part of the conversation. I mean, clearly, the role of the financial sector, this is the banking industry, is very critical. We are at the cornerstone of everything that happens in the economy. So whether it is looking at credit risk, market risk, liquidity risk, the whole enterprise management risk, how will we ensure that we have recovery and resolution, particularly those banks that have got liquidity challenges and capital challenges, this comes into equation. When there is crisis, suddenly everybody wakes up to wanting so much more data. And really that, I think one thing that we all go through is extreme demand for reporting. You'll remember that, the banks are not running in isolation as we used to do maybe 2 decades ago. A lot of us now function with third-party stakeholders, be it MNOs or other aggregators. So there's a lot of work to be done around the third-party risk analysis. Besides that, I'm sure my colleagues, I don't know why I could not be heard or seen. I had a technology issue, but we definitely have to do a very detailed sectorial analysis, and I could hear my brother Sefu had kind of covered quite a few things about that. It's also really about 2 aspects. One is the whole aspect of value protection. So once you have done a total risk analysis, sat with the regulators and done a risk analysis, and really the big things that impact us is what? Liquidity risk. And I can see that most of East African markets have worked to kind of easen up that. Have we done enough? I don't think so. I think there's so much more that is required to be done, particularly with budget coming up tomorrow, because we will all have to put in so much more to support the government priorities. So that is one. 2 is on credit risk. Really, that was a huge opportunity to try and see if we can all leverage on each other from shared learnings. Now, definitely, we've had some room for restructuring and rescheduling and really looking at the impacted sector. But have we done enough? Again, if you look at the global situation, I think one of the things we should not forget is, we sometimes feel that we are much more resilient locally. But you all have learned that, there is no economy that only survives on local models. We are all dependent on the global models. So it's very important that as we're doing risk analysis, we integrate the global challenge into the equation. And we are all very dependent. All our economies are very dependent, using the global scene, be it, commodities or exports and imports generally. So the whole area of credit also needs to be looked at from that perspective. You talked about digital. I'll come back to that. There is the need to look at capital buffers. At this time, there are banks that are running tight, and you don't want any bank to go down or get challenged because it will create another, challenge, which is, around trust. And at the moment, people are already very risk driven, so you don't want to add pain to the equation. Finally, it's about a lot of engagement to drive confidence. Now, to your question about digital, I mean, clearly, whilst we're talking about value protection, there are many areas of value creation. One of the biggest areas of value creation is digital. If I have to give you a case in point, last year, Tanzania, from a few years ago, I remember 6-7 years ago, we're talking about 252 billion shillings worth of digital transactions. Last year, we hit 100 trillion worth of digital transactions. I have no doubt that can actually be made 10 times exponential. If anything, this is one area where globally we are equally competitive as America is or China is, only that they use data much more effectively, and they use solutions much more effectively. But the power of digital generally is equal to the whole world. So we definitely need to optimize on this. How can we play it bigger? I think just generally across the country, there is a general sense that, if you look at the equation overall East Africa, I think it's 50-50, if not 60-40, where 50% of the money is in the formal sector and 50% is in the informal sector. Digital is one way of integrating the whole economy. Just moving from cash to digital, definitely releases a lot of risk around COVID-19. Ultimately, it's also about driving cash flow in the economy. You realize that from a financial institution, every shilling that is in the formal sector actually generates much more returns. So that is a big opportunity. I think the whole collaboration between MNOs, banks, we need to also come out with an East Africa policy of money movement much more effectively. I know that COMESA and SADC have some better models, and we need to do that. So clearly, like I said, 100 trillion in Tanzania could easily become 500 trillion just for Tanzania. So that's the kind of opportunity we're looking at. Also, I think there is, whilst we've only gotten much more in the space of, digital money, I think what is also important is utility of money. A case in point is India currently has more than 2,000 different solutions that are actually utility driven. Now, I know in the East Africa region, Kenya is certainly ahead of the game, but there is no reason why we should all not have 500 or 1,000 things of digital transactions or digital money. So what I'm saying is that, it is a 10 times, 100 times, 1,000 times potential game that we are looking at. We just need to open our minds to the whole area of value creation through digital. I hope that kind of answers your question.
Thank you very much. You've stressed in terms of value creation. And of course, as you know that in EAC, we are on the course of achieving the monetary union.
That's right. It's long we are in the course of achieving, correct.
Yes, we're in the course of achieving, of course, monetary union in our region. So what do you think fiscal and monetary measures that should be put in place to actually move towards that goal, and how has COVID-19 affected, of course, the momentum of reaching that goal?
I came to the East Africa Business Council meeting, I think, which was in Arusha, not very long ago. And we said 20 years ago, we had a dream that we'd be walking across boundaries or borders with much more ease. It's become complex. I think COVID-19, it has become even more complex sometimes. But the whole idea of East Africa, monetary union, which I think was actually announced in November 2013, was a lot much more around harmonization. So whether it's the whole area of financial sector, payments and settlement, which I just spoke about, has a huge opportunity. The whole accounting and reporting, again, has a huge opportunity. There's no reason why we should all not say, Uganda, just deal with this aspect, Tanzania, just deal with this aspect, Kenya, just deal with this aspect, and a few other countries. There's the whole area of standards and statistics. I think it continues to become a big opportunity. I think what we need to work on is what can be done. As leaders, and certainly, again, this goes all the way through to politics, we spend much more time on what can't be done and what advantage are we losing. Let's start with a mindset of what can be done and what advantage can be gained. Because, trust building also is really about moving forward, not just moving backward. And for that, your brain should also move forward. I think there is areas at the moment, clearly with COVID-19. We all know that there is no rule book to this game. It's a big challenge that we are all facing. You can see the most powerful nations in the world are really struggling. The best things we could do together at the moment is really the whole area of risk analysis. What can we do? Number two is we're all going to be resource constrained in their own ways, really, because importation is going to be a challenge, or exports are going to be challenged. Can we not see that as an opportunity to work together in financing that? For us, across East Africa, there's a huge opportunity of capital mobility. All the three governments have good plans around infrastructure. So I saw Sefu, kind of elaborated, how do you enable private sector to become a much more bigger player in these times? I also think that one of the big things that we are losing out from a monetary union perspective is really experience sharing. Through this pandemic, there is need to have at least, if not bi-weekly, a monthly minimum, a solid engagement between the key players in the private sector, really the whole central banks of the different markets, and see how we can harmonize things that can be done. Crisis is the best time because you really don't have the experience to deal with it, especially in this time. So within crisis, what can you really embrace about each other and make a difference? So I think monetary policy can start with a lot of small steps, so that ultimately, when we go to the big steps, we will have built enough trust amongst ourselves to drive the bigger equation. I think I've explained well. Thank you.
Thank you very much, Mr. Rugani. And of course, as building up from what Dr. Olaka had said earlier, and of course, given the importance of the financial sector and the role it plays in our economies, what do you think are the lessons that we can learn from at this time, and that we can use to
Good. So I guess a few things from my side in terms of lessons learned. One is we all need to put an equal amount of time on value creation and value protection. We're talking about financial services sector, which is where I am a leader in. Number two is, like I said, experience sharing is critical, and I think it's a very easy, we call it low hanging fruit. The whole equation of digital intermediation, aligning on our systems and models, creating an integration is again a very low hanging fruit. I think that there are other areas where, if I see the global, experience, there's been a lot of experience sharing around balancing the equation between, what is the role of the government and what is the role of private sector. If anything, this is a big opportunity for private sector, and in this case, the financial service sector. I think there is needs to, regulators generally tighten the equation. Innovation doesn't come from tightening the equation. This is a good opportunity to allow the private sector to really drive the innovation within some regulatory framework, not regulations, but regulatory framework. There is need to look at harmonizing the frameworks, in terms of capital movement. I think together we can actually invest in each other much more, and that's an opportunity. And it can be driven much more from a private sector, because you have to be in the game to understand the risk and the business itself. And together, you strengthen the equation around, risk analysis. I also think that, one of the things that we miss out on in terms of, value add is this whole area of regionalizing infrastructure, where we can enjoy economies of scale. So if you look at East Africa, what infrastructure do we have today which can actually be equated from a East Africa region perspective? Value it and then create economies of scale around it. And finally, it's about also optimizing on elephant opportunities. We are all going to be in this challenge for another 24 months. How many of us have really taken time to look at what are the big elephant opportunities around us? Time is of money. We need to look at what is competitive advantage. So if I look at Tanzania, we have extreme gas reserves, that could be used to fuel the energy system across the region. That's a big opportunity. And for that also, we need to leverage on each other's capital, because, the global capital is going to be much more challenged. So really, it's about balancing really the function of the government and the private sector in much more effective manners, and also speaking and listening to each other. And I want to re-emphasize listening to each other, because that's how we build trust. Thank you.
Thank you very much, Mr. Rugani. And of course, I think the point that you are stressing the most is experience sharing among the region. Thank you very much. I'll get back to you later. I would like to ask if the representative of Alhaji Ibrahim Kadunabi Lubega is present.
Yes, I am around.
Thank you very much. Of course, I hope you've been following the discussion. And of course, the insurance subsector is also within the financial sector. And I think we've also seen that it has been hugely affected during this time. So if you can give us what is the state of play of the insurance subsector, of course, focusing on the EAC region. And within this, how has the payment of the premiums for the insurance policies been affected? Of course, with the focus of both businesses and individuals. Welcome.
Thank you very much. Once again, my name is Protazio Sandi, Director of Planning, Research and Market Development at the Regulatory Authority of Uganda. About the state of the insurance in the EAC region, of course, I will speak from Joseph Sheffield submission that insurance thrives in a thriving economy. He ably demonstrated that the economies have been challenged, and many of them have adjusted their projections downward. in view of the impact of COVID. So that said, the insurance sector being complex, it is characterized by very complex operations, and traditionally, insurance has been handled on face-to-face. So with COVID and the various government interventions required social distancing and working away from home, initial insurance was heavily challenged. Now, what I see happening in the region is that the insurance sector is slowly adopting technology. And actually, as regulatory bodies, we are with it because we've been talking about technological adoption, applying technology insurance, but the uptake has been very, very minimal. So what should have been actually done in 5, 10 years has been done in a matter of 2 days, because that is the only way companies have survived. But this has come with also challenges, because when you look at what is happening in the market, some less essential workers are being laid off. And at the moment, we estimate about 10% of the workforce having been laid off because of technology adoption. And the most significantly hit group of these people is the insurance agents. Many of the countries have been restricting movements, and insurance agents traditionally have had their businesses through moving here and there. So we expect a drop in the agency force in the medium term of about 50%. Now that is not very good, not only for the insurance sector, but for the countries, because unemployment seems to be a challenge in most of our jurisdictions. So about 50% of the agency force is likely to be rendered jobless because they cannot sell insurance. Now, looking at the performance of Q1, that is January to March, there was some positive growth because, as I think Joseph, another colleague, pointed out, the effect of COVID was not yet felt in Q1. But in many countries, we see growth of about 10 to 12% in the first quarter. But Q2, the statistics which we have already seen point towards a reduction in some classes of insurance of up to close to 50%. So on average, we are putting the average to about 30% decline in Q2, with some expectation of mild recovery in Q3, following the reading of the budget and implementation of the same. In terms of premium payments, of course, there is a challenge here. And the challenge is that people have not been earning. If you don't have adequate resources, among the things that you think about last is insurance. You're not going to buy motor vehicle insurance when the car is parked, or even when it has to move. You can probably buy the third party, the statutory cover, but do away with comprehensive. We've had, of course, almost premiums coming from travel insurance declining almost zero due to the ban of international travels. Premiums from marine, because of the restrictions on international trade, have significantly dropped to almost 5% of what was coming in during the normal periods. Premiums from infrastructure projects, because most governments have been focusing on strengthening the health sector. So all the other infrastructure projects have almost come to a standstill, and premiums, significant premiums in the region were coming from those infrastructure investment projects. And of course, a number of them are funded by FDIs, which have also significantly dropped, as one of the colleagues already pointed out. Now, because of that decline in income, as regulatory authorities, and I was checking with the other partner states, we have provided guidance on grace periods, extending grace periods. Many of the policies usually have what we call grace periods of 60 to 90 days, and we have engaged the markets, the private sector players, to extend these grace periods by, for instance, in Uganda, we allowed extension by 90 days for life policies over and above the existing grace periods in the policies. But for non-life, especially those which have installment arrangements, be extended by 60 days over and above the existing grace periods. This is aimed really at making sure that the policies do not lapse. Otherwise, we have already noted a trend of policy lapses, especially for the life covers, where people are not able to continue remitting their premiums. And for policies that have premium warrant clauses, that's a challenge. So to avoid massive lapses, there has been regulatory interventions in that direction. Then on the issue of liquidity, because the inflows are very minimal, and as expected, we have said that if we don't regulate the liquidity stance, there is likely to be a challenge on solvency. And across the region, regulators have provided guidance on things that would take out money. For example, the payments of dividends. We have said first defer the payment of dividends, do a robust stress testing, and when the results are favorable and subject to the regulatory approval, then you can go ahead and pay the dividends, because we feel that companies may struggle a lot if we allow them to continue handling businesses as well. The other one is the issue of payment of bonuses. We have also said defer the payment of bonuses, not until you have demonstrated to the regulator that even with the payment of those bonuses, you will still remain afloat. We have required that companies now intensify on monthly submissions of their liquidity positions, because we need to now monitor on a constant basis in view of the fact that very minimal resources, very minimal inflows are coming in form of new businesses, but also in form of renewed businesses. That's what I can say as far as the stance of the insurance in the region is concerned. But maybe I would also add that even with these challenges, the insurance sector remains highly capitalized. Even with these challenges, I want to say that the sector remains highly capitalized, but depending on how far and how worse this pandemic gets, we cannot take the impact on their balance sheets for granted.
Thank you very much for those great insights. Of course, you've told us the state of play of the insurance subsector, and of course, you've also highlighted the measures that you've put in place from a regulatory perspective. Thank you very much. We've received a few questions from the chat room. I would like to read them out. The first one is, of course, directed to Dr. Olaka, which says that how was the cash strain on businesses and reduced consumer spending on goods and services affected performance at the Securities Exchange? So that is for Dr. Olaka. If we can proceed to the next one, which is directed to Mr. Joseph Sheff, and it says that EAC partner states have put in place stimulus packages to cushion businesses. What would be the starting point to ensure that all the sections of the private sector benefit across the board, including SMEs? That is directed to Mr. Shefu. I think it's the inclusivity of all the private sector, including the marginalized, of course, SMEs. And we also have a question that is also directed to Sanjay Rugani, which is how has the EAC financial markets being affected during this time? and what we can foresee in the near future. So if we can start with Dr. Olaka on addressing the question on, of course, how has the cash strain on businesses and of course the reduction of consumer spending, how has it affected the performance of the security exchange? Karibu, Dr. Olaka.
Yeah, thank you very much. I wouldn't say that I'm an expert in the capital markets arena, but I can give some thoughts towards that question in terms of the cash strain in the consumer and the impact it has on the movement of stock values on the securities exchange. And I guess maybe that's a question that was meant to be applying across the whole of East Africa, the various stock markets, security exchanges in, across the region, but maybe using Kenya as an example. You may notice that there might be some element of correlation between the movement of the values of stocks and as reflected on the various indices measuring the value on the various stock exchanges, and the general well-being or the economic well-being of the players, the investors. And I think I had mentioned a little bit earlier about, in my remarks, I had mentioned about the fact that currently most businesses are operating less in an investment mode and more on a day-to-day survival, as they struggle to utilize the existing capacity just to maintain some level of operations for those that are still able to manage operations. So basically, investors tend to pull out from looking at it from an investment perspective, and they try to conserve the little cash they have. So the activity on the securities market would generally be into a slow mode, where you see the activities certainly reduce. So the parameters that measure the level of activity, and that's normally the indices that track the performance. Like, for example, on the Nairobi Securities Exchange, we have got the NSC 20 index and a few others. You'll see there has been deliberate or a consistent slowdown and reduction in that index, and I think that applies across the whole region. I've not directly tracked the performance in the respective markets, but generally, because of the correlation, you'd expect the same kind of movement in the value of the securities. Thank you.
Thank you very much. If we can proceed to Mr. Shefu.
Thank you, Miriam. So we have seen stimulus packages being issued by governments. All governments in the community have actually issued the stimulus packages, and we expect more stimulus packages to come in the budgets that will be read tomorrow by the member states. So one aspect of the stimulus package that has been issued, and certainly that has been one of the criticisms, is that it seems to focus more on established former businesses, which already have access to finance, for example, and for that reason. So, but that's just a criticism, because some of the stimulus packages do cover both SMEs and established businesses. In some countries, I understand in Tanzania, we have done mapping studies to look at the sector that has been impacted, and to also come up with stimulus packages that are more focused on a particular sector of the economy. But again, we have seen that the larger part is informal sector, and SMEs probably would probably largely fall part of that. So the engagement between the private community, private sector community, and the government is important to be able to roll out a package that is more suited to and also addresses the peculiarities of both SMEs and established businesses. What we see that the survey by East Africa Business Council, it indicates that about 50% of businesses would not last more than 12 months with the say if the COVID-19 pandemic will continue to prevail and in the next 12 months. And the predicament for SMEs is mostly lack of cushions. And for most, the fallback position is normally to outright closure of the businesses. So it's actually important to look at that. But also, when we look at SMEs, for example, key issues that they face on a day-to-day as SMEs vis-a-vis the well-established businesses will be ease of doing businesses, securing business license as an SME, and because of the informality with, in terms of our business processes for SMEs, make it difficult for them to secure business licenses. In Tanzania, you'll be required to secure also tax clearance certificates every year if you are to secure a business license. So many businesses probably will operate without a business license. So looking at easing those regulatory hurdles that SMEs face on a day-to-day, and other requirements, for example, advanced tax payments requirements in terms of provisional tax that are required to be paid upfront to be able to secure a tax clearance certificate and therefore be able to secure your annual business licenses are some of those issues that have to be looked at. SMEs also do employ a sizable number of employees. The administrative burdens in terms of managing tax affairs with multiple regulatory authorities, those can also be looked at, and but also cost burden to SMEs with regards to these taxes, especially on employment taxes, and so on and so forth. But also for established businesses, we probably need to adapt affirmative action plan to support SMEs, because many SMEs also operate, do business with the established businesses, but they certainly face hurdles. Some of the hurdles including opportunity to probably provide services, goods and services, those established businesses. For example, do established businesses tend to provide opportunity to fellow established businesses? How many established businesses have got affirmative actions to support SMEs? And this is the time now we probably have to look at that. So SMEs may have issues around quality of their products, but what can be done to support them such that they can support established businesses and having an affirmative actions? But also when they supply established businesses, also they face hurdles like, for example, payment terms. And SMEs may have to wait for 60 days to get paid for goods and services from a well-established businesses. But again, SMEs don't have access, equal access to finance, for example, similar to established businesses. So those are some of the aspects that we can, both the private sector and the government sector can look at it. But I think starting point is engaging business community with the government that is setting up these policies, both fiscal policies and monetary policies, but also for established businesses also to try to look at it in what way they can actually support business community below the lines.
Thank you very much, Mr. Thank you very much. If we can proceed to Mr. Sanjay Rugani. Mr. Sanjay, please unmute your mic.
I think the question for me was really in terms of, from an East Africa perspective, what is the impact on the financial sector, and what are we expecting to see in the future? So a few things, and I think some of my colleagues touched on this. My personal perspective, having looked at all the data and spent a significant amount of time, I'm also the deputy chair of the Bankers Association in Tanzania, is on an average across the industries, we are seeing an escalated risk of at least 30%. Now, certainly hospitality industries, etc., are much more vulnerable. We've just heard from Joseph about SME, so that's going to be a very critical area. Now, when the average risk increases, clearly it has implications around credit considerations. One of the things that we are seeing is the number of clients who are failing to meet covenants. This is a banking term. In essence, what we are talking about is, how many of them cannot meet their obligations, particularly from a cash flow perspective. So many of our clients are becoming cash flow negative, and that's a challenge in business. We have to do a lot much more analysis on how much they can sustain that. So when cash flow is tight, it constrains liquidity in the whole system. Now, fortunately, the central banks have taken measures, so it's been a good support mechanism. But clearly, we need to look at sustainability. So the current models need to move into sustainability. So that's going to be a forward-looking game. The other impact we have seen, as I talked about initially, is the number of reporting we have to do and analytics. Really, because we all are still trying to understand risk from a whole holistic perspective. I think the game going forward is going to be much more about agility, adaptability, and alignment. It's been a long time that we've not been aligned. So whether it's private sector, government, whether it's financial sector, central bank, this crisis has taught us that you can't win some of these battles alone. So we'll come up with new frameworks of how do we align and where do we align, and where we can do independent management. The other area which is very significant, and I don't think this is something that the community is aware about, but I'm also the global chair for the professional accountants in business from the International Federation of Accounts. So one of the things we're looking at is just the whole accounting standards, and we also don't want to be very disruptive to the industries. At the same time, we want to be supportive. So looking at the whole angle of IFRS 9 and the provisions, there is no doubt that the NPLs are going to really hit the roof for some time, and particularly the next 24 months, and we'll have to take a lot of time, one, to understand them, and two, to measure them. But from the global accountancy standards, we're trying to look at, to what extent, we do give some flexibility. I guess the other thing that's changing in the financial markets is just the scrutiny from the board, scrutiny from the investors, because I think profitability for the next 2 years is going to be very challenging. So I think it's a phase, as Jack Ma said, if you survive, you've actually have made profit. And I think that's the phase we're looking at. One other big factor that we've not talked on this call is just the whole area of sovereign risk. At the moment, globally, a lot of risk analysis and global bodies are looking at, so what is our sovereign risk? We've seen a downgrade of sovereign risk for Zambia. I know there's a lot of assessment happening. There are a lot of eyes on the budget for tomorrow, and to what extent, the leaders are going to be much more realistic. And that's going to really drive, the element of sovereign risk that is going to be implied upon the economies. Now, that has a huge impact, both in terms of, the risk-weighted asset. If you look at, assets from a global perspective, the investments that will come in, because it's really going to drive risk profile. So the regulators at this time, working with the financial services or sector, need to really come up with reforms that are going to drive the mindset of confidence and the ability to, like I said, be agile and arrest, whatever risks that are going to be there. Clearly, not everybody is going to win, but our ability to manage this in timely manner is going to be a key equation. Also want to talk about cyber risk. It's a big issue. Just with you asked me the question about digital. I was just looking at statistics yesterday. There has been a 660% growth of usage of digital in the banking sector overall. Now, this is going to drive a lot of cyber risk. So really, it's a big impact for us. Some of us are very, very strong and have put in a lot of investment. I think this is a big time we will have to look at, whether our platforms are robust. So again, from a forward-looking perspective, this is going to be very critical. And finally, it's about, modeling risk-based behaviors. We'll all come up with new structures and frameworks of how we'll analyze business. There's going to be opportunities that are going to be short-term. So how do we analyze them from a funding perspective? Because there'll be new business models that will be coming out, and it's our ability to support this. Remember, we are also very constrained because sometimes our judiciary systems don't enable us to recover funds. And secondly, sometimes there is constraint around just our regulations. So our ability to work together, and I think this is what some of my colleagues spoke about, the whole engagement model between banks and central banks, between the region itself, try and do the shared learnings as I talked to you about earlier, and really tightening up the judiciary framework, because if anything, just the behavior needs to be better managed so that we can continue to support the economy. So these are big learnings in terms of impact currently and issues that will continue to haunt us for at least the next 18 to 24 months. Thank you.
Thank you very much, Mr. Rugani. Of course, we are running out of time, but we have 2 more questions for Engineer Jennifer Gache, and of course, Sampo from the Regulatory Authority, Insurance Regulatory Authority. So starting with Engineer Jennifer, and of course, in light of the budget hearing tomorrow, what are the major measures that we can expect from the partner states? Of course, with regards to the recovery, which are of course in line with the EAC industrialization strategy. And what is the face of industrialization, of course, during and post-COVID in East African region? And of course, we have a second question that is directed to Sampo of the Insurance Regulatory Authority of Uganda, which says, as a regulator, and given that the insurance sector is a big investor in the financial markets, are businesses and people's insurance covers and investments safe? I'm going to repeat the question. As a regulator, and given that the insurance sector is a big investor in financial markets, are businesses and people's insurance covers and investments safe? So if we can start with Engineer Jennifer, then proceed to Sampo. Welcome.
So thank you very much, Miriam. For the COVID has affected manufacturers in that when most of businesses were starting to operate in this financial year, their concern was about how to make profit and reduce costs. But with COVID coming in now, most companies are actually struggling to survive. And in a survey that has been done in a couple of companies, at least over 78% of them would like to reduce costs, retain jobs, and also improve their cash flow, most of them. And most of the, due to the containment measures, most organizations have cut their operations short. So you find that whereas someone might have been operating at maybe 70 to 80% of capacity, now the capacity is at 30 to 50%. So this has greatly reduced even the profits. So the way the manufacturers would want to approach the financial sector and through the central bank, they would actually seek for additional support from the lending institutions so that they can enhance their liquidity. And they would want the financial institutions to increase moratoriums for loan repayments, decrease interest rates to loans, give loans and overdraft books more period of time, and also put cap on fees for rearranging facilities. Then looking at the way, the kind of measures that the government is talking about. So many manufacturers have had to readjust their production, and in some cases even realign the factory floors so that they can be able to manage the social distancing. So there should be some, the government needs to consider increasing some corrective actions, looking at issues like voluntary disclosures and other ways of managing disputes, and also looking at actions that are more fair and also more expeditious and efficient in the way they handle things with the private sector, and having very clear procedures as to how business are going to be conducted, or any kind of suspensions in operations and brands for that purpose. So the manufacturing sector have had to ramp up on the production of essential goods. But as the production of as those who benefited from the production of essential goods made a bit of profits, those who are not in essential goods are about to take a bigger beating, because for them, definitely their margins have gone much lower, because already people are not spending, so there's not enough money that is circulating in the economy. And for this reason, now the region needs to, and the manufacturers needs to identify some products that were probably being imported, but now they from abroad, and try to import this locally, to try and manufacture this locally. But for this to happen also, there has to be that support by the government. The government needs to give incentives by giving things like tax holidays and all that. A couple of presenters have talked about innovation. Innovation and technology transfer is going to be very necessary also in recovery, because when there's the region may lack capacity in some areas, but with this kind of technology transfer and enhanced skills, this can be developed. I've heard about the issue of risk management, and especially for the SMEs, credit guarantee schemes at this point can help to better the relationship between the private sector and the financial. So if there could be some schemes that bring about credit guarantee schemes, and also the support by the government on local procurement. So the government need to support local procurement of products, so that the cash flow, the government as the biggest spender, the cash flow for these manufacturers can be reduced. Then looking at the issue of the tax reliefs, when the government, when most governments have declared a number of reliefs, they have also introduced VAT on a number of items, which were previously zero rated and exempt from VAT. So by doing this, of course, the cost of doing business has become more expensive. So the government needs to reintroduce some of these reliefs, like on items like wear and tear allowances, and reversal of this policy, of these taxes can be done through the policies. Then we have the issue of the moratorium on changes in the tax regime, because right now everybody has been caught unawares by this pandemic, and for this reason, in order to enable business to continue, such kind of measures should be considered, because businesses are already tight for cash. And of course, the financing and emergency, we cannot forget about the emergency response plans, and also economic stimulus program, because economic stimulus program work towards promoting inclusivity. And you find that having an emergency, some funds can also enable, especially the micro, small, and medium enterprises to continue operating. Because some of these MSMEs have been forced to, they're trying to see the best way to retain their employees. So if they can be somehow given some of these grants, some of these stimulus packages, it can lead them to retain some of these employees. But generally, the way the region is moving, there's the general idea of having a very comprehensive rebound plan, working across sectors to see to it that that business continues, and some of the sectors, like the manufacturing sectors that normally requires very long financing periods, are cushioned more than probably other sectors that the financing is a bit more easier. So I think, Miriam, I can stop there.
Thank you very much, Engineer Gashi. We are running out of time. Sampo, if you can respond very briefly as we are wrapping up.
Yes. I'm standing Sampo, but the question is about the people, I think, are a bit pessimistic about the sector and whether the investments in insurance are safe. Like I said in the beginning, is that the insurance companies are well capitalized and actually highly regulated. One of the most highly regulated sectors in the world is insurance. And the good news is that most of the regions now are towards what we call risk-based supervision. So even with this impact of COVID, what is likely to happen is that many companies will be required to inject in more capital to keep at pace with the risks that they are experiencing. So yes, their investments are safe and secure, and the different regulators in different jurisdictions have, in the short run, tried to regulate the liquidity, but also the liabilities to ensure that the companies are kept in a balance. So we are giving assurance to the various insurance consumers and beneficiaries that the sectors.
Thank you very much. As we are wrapping up, I would like to welcome all panelists to speak for 1 minute. Please let us be brief as we are wrapping up. For 1 minute to really tell us what is the key takeaway from this webinar. If we can start with Mr. Joseph Shefu, welcome. 1 minute, please.
Thank you, Miriam. So my take actually is, I think the pitfall that the government should avoid as they go about setting up the budgets. One of the pitfall is actually government have to change. Maintaining a business as usual attitude will be a pitfall. So they have to direct resources accordingly with the COVID. Focusing on revenue raising against reviving businesses. So we should focus on reviving businesses and promoting more businesses rather than focusing on revenues. And also one of the pitfalls also is like escalating geopolitical tensions and barriers. That will be one of the pitfalls that we should avoid. And also ignoring informal sector, vulnerable groups, women, children, indigenous and ethnic groups, which we may say maybe it's not a priority now. We have a big issue to tackle. And also ignoring environment is another pitfall. So environmental sustainability of our world is important. Businesses also have their emerging businesses that businesses they can look at. Demand created by decline in imports. The local industries can grab that. Of course, there are issues around capital barriers, but capital markets also are called into play here in terms of facilitating local industry to grab the opportunity that is actually brought about. They have to engage government, be innovative to tailor policies. SMEs, they can consider merger and acquisition. It's another opportunity rather than shutdowns. And embracing digital technologies and affirmative actions by private sector to support SMEs. And also PPP, private-public partnerships. It's a time now to engage to build more trust between private sector and government sector, supported by local and regional trade bodies like East Africa Business Councils, and encourage business development partners should also offer stimulus, focusing on promoting private sector developments, and let's leverage on regional capital, both human and financial. Thank you.
Thank you very much, Mr. Shefu. If we can proceed to Dr. Olaka.
Yeah, thank you very much, Miriam. I think this has been a very engaging discussion with a lot of learning points. But what I would more or less pick as my take home on this is the fact that and if I can speak from the perspective of the banking sector, I think the banking sector, and this across the region, is well positioned to support the economy as we try to manage this pandemic and the weight that it puts on the economy. Banks currently are in a very good position from a capitalization point of view, and also from a liquidity point of view, especially with the support of the regulators in the region. So they have put the banks in a good position to be able to support the economy. But of course, one of the things that we need to do is to be able to balance, because of the fact that we do not want to get into a situation where we resolve a health crisis and we leave ourselves in a financial crisis. So we need to balance the point whereby banks are institutional whereby they support movement, or rather the recovery from the health crisis, but remain strong for the future. Thank you very much.
Thank you very much, Dr. Olaka. If we can proceed to Engineer Jennifer Gache, 1 minute, please.
Yes, thank you very much. As it were, the manufacturing sector is already having a lot of attention that is required from the government in terms of promoting real industrialization in the region. So as the government set the budget, they need to think about the global, regional, and local value chains, because we have already seen now this kind of pandemic has really developed, has really affected the global trading. And think about each and every sector. And the region needs to build its own capacities in order to become more self-sufficient and to have more complete value chains. So whatever the measures are being put into place should be those that are enabling a number of sectors, especially those that have been deemed to be priority, to develop more, and for there to be more diversification and in-depth development. Also, the government needs to think about the real economies of the country, and particularly things to do with the East Africans, the youth, the employment, and the long-term effects of the actions, as opposed to short-term measures of trying to get in as much revenue as possible in the shortest time. So the budget should be focused on all the time trying to see to it how to make sustainable growth and sustainable development for the East African, and that goes for working in areas where there is quite a bit of long backwards and forward linkages, long value chains, and these kind of sectors with such long value chains also support very well the services sector. And I think the services sector is also equally important. So for me, that is what I would say at my parting shot. Thank you.
Thank you very much, Engineer Jennifer. If we can proceed to the representative of the Insurance Regulatory Authority. 1 minute, please.
Okay, I have 4 issues. Number 1 is that investment in technology to enhance operational efficiency should be a priority for every insurance company, because that is the way to go. Number 2, they must control the costs, because in view of the limited inflows in the short and medium term, the only way to balance the books would be to, as much as possible, control the cost without necessarily impacting on the obligations to the policyholders. Number 3, we are, as regulators, we appeal to the various shareholders, be patient, dividends may not be paid. And actually, there are also likely instances where some regulators may demand for more capital input, capital injection, to ensure that the companies remain afloat. And lastly, for the regulators in the region, we need to fast track the development of regulatory frameworks for sandboxes, because it's not business as usual. It is business unusual, and for that business unusual to be facilitated, we must have an enabling framework that accommodates innovation. Thank you very much.
Thank you very much. Can proceed to Mr. Sanjay Rugani. 1 minute, please. Please unmute your mic.
Sorry. I will echo what Habil said about the banking industry. In Tanzania also, we've really enjoyed very strong collaboration with the central bank, and we continue to be very resilient, both from a capital perspective and liquidity. He talked about, don't try and resolve just a health crisis and leave a financial crisis. I think what is also important is that we should not leave a crisis for people who are living. So I think some of these economies, the way we are opening up is much more effective. So that's one, banking sector is strong. Number two is really optimize on your biggest potential at the moment. Just want to remind everybody that 90% of each of our economies is private sector. It's your best time to expand the leverage on PPPs, and optimize on your best value assets. The private sector is the one that is going to bring investment to the best opportunities. The third thing really is for regulators again, and as we are doing budgets, I think a phrase that I use so much more nowadays, and this is much more from an East Africa perspective, that if you cannot make things easy, please don't make them difficult. We already have so much difficulty. So as you're driving new policies, please be aware there's enough pain around us. What we need is collaboration, and we need progress. And the last one, really, this is for all the leaders on the call and leaders across the region, because leadership is being tested. And we'll all know that none of us have gone through elaborate learning on leadership in crisis. So my only question to everybody is going to be, is COVID-19 managing you, or are you managing COVID-19? Thank you.
Thank you very much, Mr. Rugani, and I hope we'll be managing COVID-19. Of course, we've had some very great insights throughout our webinar. I wouldn't like to reiterate what has been said by our panelists. Of course, we've gotten an insight on how the financial sector has been affected during this time. We've also gotten insights, of course, on what we can expect from tomorrow's budget hearing. And of course, we've had a lot of recommendations and actually perspectives on what the budget can focus on. Just to highlight a few, it has been addressing, of course, cash flow constraints. It has been, of course, stabilizing the economy, widening the tax gap, focusing on innovative business practices, and of course, prioritization of spending, affirmative action for SMEs, and so on. We at EABC would compile a report on what was being deliberated on during this webinar, and it will be shared to all participants. And as we close, please allow me to thank our panelists, everyone, for making time to attend this webinar on such a short notice. We really appreciate and thank you for your time. And of course, thank you for the great insights that you've provided in this webinar. And of course, to all our audience, I would like to also thank you for tuning in. We'd also like to welcome you next week. We have another webinar that would focus on, of course, the post-budget analysis, giving it a regional perspective on what would have been shared by all partner states. And of course, last but not least, I would also like to thank the team at EABC who has been working on the background to make sure that this webinar is successful. So once again, thank you to everyone. Stay safe, and I wish you a fruitful week.
Thank you. Bye.
Thank you and bye.
Thank you.
Thank you. Bye.